Welcome to the Stock Market Palantir. Today we are going to talk about SoFi. So SoFi Technologies, trading up in the upper 20s here in late November of 2025, has really become one of the most polarizing and frankly frustrating assets in the whole fintech sector. I mean, on one hand, the operational story is just nothing short of exceptional. But on the other, the stock price just seems, well, structurally constrained.
Right. So the core of our discussion today has to be about that divergence. Is SoFi's performance being driven by its, validated fundamental success, or is it just a captive of market microstructure and these overwhelming valuation demands? I'm firmly in the camp that operational excellence will win out, and this price friction we're seeing is just the market consolidating before it recognizes the true value of a mature bank.
And see, I come at it from a completely different angle. While I fully acknowledge the operational success, you can't argue with the numbers. They're fantastic. I maintain that the stock is structurally capped by the sheer gravity of expectations. I mean, the market has already priced in a flawless future, and sophisticated institutional flows are actively managing their exposure, especially anytime it gets above that $30 threshold.
And that action creates this persistent overhead resistance that just neutralizes even the most impressive fundamental strength. For now, the technical friction is winning. It's just undeniable.
Okay, well, let's establish the fundamental case first, because I think that gives us the basis for challenging that friction. SoFi is fundamentally a different company now than it was even 2 years ago. We saw this decisively in the Q3 2025 results, which delivered a clean triple beat. And crucially, they achieved GAAP net income of $139 million. I mean, this is the 8th consecutive quarter of GAAP profitability. It solidifies their transition to a full-fledged, viable, and profitable bank. The model isn't just validated, it's proven sustainable.
But the real long-term strength is in the diversification, the execution of that super app model. And this is key because it shifts the dependency away from just pure play lending volatility. Fee-based revenue surged 50% year over year to a record $409 million. The financial services segment, which captures all that activity outside of loans, grew a staggering 76%. This proves the super app concept works. They've built a sticky, integrated ecosystem, and the metrics confirm it. 12.6 million members, 18.6 million products, both growing robustly at around 35–36%. The cross-selling pipeline is just deep.
That's a compelling argument, I'll give you that. But have you considered the incredibly steep price the market is already paying for those fantastic growth rates? I mean, if SoFi were valued as a traditional bank, we wouldn't even be having this conversation, but it's not.
It's valued as a high-growth tech platform. The stock trades at, approximately 50.7 times trailing earnings? That requires absolute perfection.
Well, and what's more telling is the 2.46 PEG ratio, price to earnings divided by the expected growth rate. For context, a PEG ratio above 2.0 is the market sending a clear signal. It's screaming the stock is expensive relative to its expected growth. So the market hasn't just priced in the transition to profitability, it's priced in several future quarters of continued massive percentage growth without any margin for error. And this demanding valuation, it explains the skepticism. I mean, you see analysts already anticipating trouble. Truist Securities lowered its price target to $28 in late November, and they explicitly cited tougher growth comparisons ahead. You take that high expectation, couple it with the stock's volatile profile. A beta of 1.93 means it's nearly twice as volatile as the market, and it's firmly in the speculative asset category, bank charter or not. The ceiling is set by these valuation constraints until the earnings catch up. I see why you think that, and I do agree the valuation needs attention. However, I would frame that high PE as more of a reflection of the re-rating potential that's inherent in a high-growth company moving to consistent profitability, not just a measure of over-expectation. More critically, I think just focusing on the PE misses the technical manipulation that's at play. You highlighted that ceiling, and I believe that $33 ceiling is largely artificial, imposed by how institutions structure their distribution, particularly through off-exchange mechanisms, dark pools. It's true the stock is volatile, but that volatility has been receding as the company matures. The high beta is kind of a relic of its past as a pure fintech lender. As institutions accept SoFi as a legitimate diversified bank, its beta will naturally come down over time, decoupling it from those really volatile peers. We're just arguing about how quickly that happens.
I'm sorry, I just don't buy that these market mechanics are short-term noise. They are structural barriers, and they are designed to manage supply. We need to analyze the market microstructure to really understand why the price is capped. Specifically, that 40% threshold of off-exchange short volume is crucial. So on November 25th, right when that truest downgrade hit, the off-exchange short volume ratio spiked to 40.86%.
Okay.
This means that nearly 41% of all trades that day that happened off the exchanges were short sales or heavy institutional hedging. This ratio is significant, and it shows how institutions actively use dark pools to aggressively sell or hedge whenever that retail momentum kicks in. We call it the wet blanket effect. It's sustained, non-exchange selling pressure that creates this overhang near key resistance levels, and it just stifles any upward momentum. We saw this distribution really clearly on November 13th, right after the stock hit its 52-week high of $32.73. On that one day, over 68 million shares traded off exchange. That huge volume spike was a clear distribution phase. Institutional sellers used the retail frenzy to cap the rally and get out of their positions. It's sophisticated price management.
I understand the mechanism, but describing it as an insurmountable barrier, I think that minimizes the organic demand that fueled that run-up in the first place. I mean, the move from the April lows recovered nearly 300%. That velocity proves that organic demand and short covering power can and have overcome these technical maneuvers when the catalyst is strong enough. And those spikes in short volume you cite, they're often just temporary hedging requirements that are necessitated by such a massive parabolic move. Besides, if the institutional suppression was so structural and long-lasting, why did the off-exchange short volume ratio just drop precipitously to 27.75% the very next day on November 14th? That decline suggests sellers were exhausted or they were actively covering shorts. The selling happened, sure, but it's a consequence of the stock's velocity, not a reflection of some intrinsic structural value problem.
I'm just not convinced it's temporary noise. It is a recurring pattern, and it's tied directly to skepticism about the underlying credit risk. That nervousness about consumer debt is exactly why SoFi's dark pool ratio is so comparable to pure lenders like Affirm, which sits at 37.13%. Institutions are treating them similarly despite SoFi's bank charter. They see a high-growth lender, period. And, okay, let's pivot to the retail side, because the fractured behavior there just makes the volatility worse and actively fuels this technical cynicism. The fractured retail sentiment creates a psychological ceiling, and specifically, we have to look at the governance discount tied to insider selling. $250 million worth sold around November 20th. And while executives sell for many reasons, the size and timing of that sale, right after a massive run-up, it fuels what the retail community calls bag holder fatigue. It creates this immense cynicism that management is just using retail buying as their exit liquidity.
That's an interesting point on the psychological layer. However, I would frame that insider selling a little differently. I mean, large planned sales are standard in highly compensated tech firms, and a $250 million sale, while significant, should be viewed in the context of a company whose market cap is in the tens of billions. Just dismissing it as exit liquidity oversimplifies corporate finance necessities. More importantly, I'd argue the influence of this fractured retail sentiment is it's waning. Yes, you still see the speculative gamification in some forums like those banned bets on hitting $27 in 2 days, which confirms a highly momentum-driven cohort exists. But as SoFi matures into a GAAP-profitable chartered bank, its price action becomes less susceptible to those classic meme stock dynamics. The true anchor is the fundamental pivot. And this stability will attract long-term institutional capital that is far less concerned with drama on message boards.
It's difficult to dismiss that retail psychological layer entirely, especially when institutional sellers actively anticipate this behavior. I mean, when the message boards are flooded with overly bullish posts, experienced traders anticipate a dump at the bell. That's technical cynicism in action. the market is actively inversing itself, and this fracture in conviction means that the retail group cannot sustain a parabolic break like they might have historically. And without that unified retail fuel, that technical barrier becomes dramatically harder to overcome. The institution knows the retail buyer lacks the conviction to hold through a downturn, and that just reinforces the ceiling.
Before we conclude, we really have to address one specific source of retail anxiety that feeds right into this. And that's the persistent confusion around the reverse stock split narrative. It just continues to be the zombie narrative for no good reason.
Oh, absolutely. It's critical we clarify that because it's a specific element of the structural friction we're debating. The anxiety comes from two separate events that people are constantly mixing up. So on the corporate side, for SoFi Technologies, the company SoFi, the board did get authority back in 2022 to implement the potential reverse split.
Correct. But that authority was pursued when the stock was trading in the single digits. It was about the theoretical risk of delisting or, institutional mandates. Crucially, the board let that authority expire, unused. Now that the stock is near $28, the entire rationale is completely obsolete. There is no active proposal for a reverse split of the company.
Right. And the actual reverse split that did happen, the one that fueled all the confusing headlines and panic, involved an affiliated investment product, the SoFi Select 500 ETF, ticker SFY. On October 2nd, 2024, that ETF executed a standard 1-for-5 reverse split. This is just a mechanical procedure for ETFs to manage liquidity. It was not a distress signal for the bank, but the confusion contributed directly to selling pressure in the operating company. It's a perfect example of non-fundamental technical anxiety. That clarification is essential. So, returning to the core debate, I remain firm in the business thesis. SoFi has successfully navigated the most difficult pivot in its history, achieving consistent GAAP profitability and diversifying its revenue. That $33 ceiling is a function of institutional profit-taking after a massive run, but it is temporary. When Q4 results demonstrate continued acceleration, it's going to prove that truest analysis about tougher growth comparisons wrong, and it will force the market to re-rate the stock higher. The friction is manageable. I agree the business is fundamentally robust, but the market is relentlessly forward-looking. The current valuation at 50.7 times earnings and that high PEG ratio, it already reflects significant future growth. This means the easy money from the profitability pivot has already been made. Until the cap earnings growth accelerates enough to really compress that PE ratio, or until a massive new catalyst appears, maybe a major acquisition, the structural barrier imposed by institutions and high valuation multiples will keep the stock range-bound. The stock's future really hinges on whether its operational success can outpace the persistent technical and valuation friction. Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.